Ladies and gentlemen, it is time for an Angry Advisor episode. In this corner, we have your host, John Iannucci. And in this corner, questionable life insurance. I'm Patrice Sikora. Okay, John, you plan to take on advisors who convert a client's investments into commissions by promoting and selling excessive or inappropriate life insurance coverage. What do you mean when you say converting investments into commissions?
So, Patrice, let me start by saying that, when a life insurance policy is properly designed, it's an incredible financial instrument. There are very few instruments, candidly, that provide the benefits of a properly designed insurance policy. So today, I want our listeners to understand that we're specifically talking about permanent life insurance that accrues a substantial cash value over the life of the policy.
All right. So we're not talking term insurance here.
That's right. We are talking about various types of permanent life insurance. And folks may remember names like traditional whole life,
right,
or variable life insurance that has an investment component, or flexible premium universal life. Each of these types of insurance has a place when properly designed for a client's needs.
All right. So where does the consumer run into a problem?
So I think, Patrice, the best thing I can do is give you an example. Just a few weeks ago, and you'll see why I'm really angry today. I was actually involved in a mediation for a client where she actually did not realize that two advisors had caused her to purchase various expensive life insurance policies only to let them lapse and become useless.
They lapsed?
Lapsed. They were gone, no longer in force. She had no life insurance. You see, my client was a widow. Her husband had managed their investments, and when he died prematurely, her advisor, the very same advisor her deceased husband had used for years, realized she was ripe for a fraudulent scheme. And he caused her to purchase two very expensive second to die life insurance policies. So for our listeners, a second to die policy covers the life of two insureds and doesn't pay a death benefit until the last of the two insureds passes away. In this case, the advisor actually caused her to purchase two second to die policies. One policy covered my client and her daughter, who was in her early 20s, and a second policy covered my client and her son, who was likewise in his early 20s. And the combined annual premiums for these two policies were $80,000 annually.
Oh my gosh, you're kidding. The premiums?
$80,000 annually. And here's the rub. My client was a school teacher earning a gross salary before taxes of $65,000 a year.
Well, how did she pay for the premiums?
Well, that's where it gets interesting. The advisor convinced her to sell off investments to generate the cash required to pay her premiums. But after paying premiums for about 4 years and realizing that she was extremely concerned with her rapidly declining investment portfolio, the advisor told her to stop paying premiums.
I can't believe it. I can't believe it. So he's taking from her investment portfolio to pay the premiums on these policies that are egregious.
Right.
So what happened to the policies?
So the advisor made an election to put the policies on what's known as premium offset. Essentially, he told the insurance company to start using the accumulated cash value that had built up in the policies to pay the premiums.
Well, that means then the policies won't be worth anything.
Correct. And in this case, the policies had enough cash accumulated within the policies to pay premiums for several years. But eventually the policies began to run out of cash value and were about to lapse.
What happened?
Well, just before the policies lapsed, the advisor sold her another policy from a different insurance company. He then convinced her to surrender these two prior policies to gain access to some remaining cash surrender value. But the new policy still had an annual premium of about $60,000 a year, still well above her net income.
I'm sorry, I just don't believe this. It gets worse and worse as you're going on.
Right, right, exactly. And just like before, after paying premiums for 4 years, premiums where the cash was generated by selling off investments, he put that policy on premium offset, again, because she was complaining about the cost of premiums. And just as that policy was running out of cash value, he sold her yet a fourth policy.
Oh, come on. Wait a minute. We've got to get to the insurance companies in a minute, but why would he do such a thing?
Well, the answer is exactly what you might expect. There's no other reason. He was greedy. You see, Patrice, while an advisor is managing a client's investments, he may be charging a fee equal to 1% of the value of the portfolio. That's a very common fee arrangement. But when he sold the investments and used the cash to pay insurance premiums, instead of getting 1% of the premium amount, he received a commission in the first year of each of these policies equal to 120% of the value of the first year's premium.
120%.
As opposed to 1%. That's a huge step up in compensation for that money. And additionally, as annual premiums continue to be paid, even when the money came out of the policy's cash surrender value, he would receive a commission between 14 and 10% of the annual premiums. Again, an enormous step up in compensation for both the second, the third, and the fourth policies. And each time he sold a new policy, he started over with a commission in excess of 100% for the first year's premium.
That's amazing. I mean, that is just amazing. Is it legal?
Right.
That's fraud.
Great question. And no, it's not legal. Let me explain it to you. When an insurance agent sells a client a life insurance policy, the application really is supposed to go through an underwriting approval process at the insurance company. And in this case, the insurance companies kept questioning the validity of the advisor's plan, but they let the policies be issued. And that's just dumbfounding to me. That was a huge breakdown in the safeguards that are supposedly designed to protect consumers.
All right, so let me just jump in here a minute.
Sure.
The insurance companies let this happen. They let the policies that the client could not afford still be sold and issued.
Correct. Yes, they did. But let me add one additional wrinkle. It's also illegal to replace an existing policy with a policy from a different company when the client loses some benefit. In this case, was losing that cash surrender value. And in this case, not only did they lose cash surrender value each time a new policy was sold, but they incurred an ongoing premium with a new policy. Essentially, improperly replacing life insurance policies in that fashion is called twisting, and it is most definitely illegal.
All right, John, what did you do when you recognized this was happening?
So this was a brand new client to me. She was a new client to ILG Private Wealth, and she really had no idea that she had lost nearly $1 million.
Oh, dear God.
And had no life insurance to show for it. In fact, by the time the fourth policy was going to lapse, the client was uninsurable at standard rates because of her age and ensuing health issues.
Well, okay, where does she go from here? What could she do?
Right. At first, when I recognized how badly she had been mistreated, I described what I thought had taken place. She had no idea that something was wrong. Just before she paid for those insurance premiums, she no longer needed life insurance. Believe it or not, she didn't believe my claims of fraud and conversion. The former advisor had been a very close family friend of the client for decades. She told me I had it all wrong.
Well, what did you tell her? I mean, you've explained it already. How did you convince her?
So here's what I did. I actually coordinated meetings for the client with several independent law firms, 3 exactly. They each proceeded to describe the level of fraud and conversion. And conversion is when somebody takes your asset and converts it to their property illegally. They estimated that had taken place in every one of her policies. And eventually she realized that my initial assessment was correct.
Okay, and then what happened?
So I helped the law firm that she selected draft a complaint, a comprehensive complaint against the 2 advisors, the 3 insurance companies, and the 4 broker dealers that I thought had either taken advantage of her or failed to protect her. We filed an incredibly significant lawsuit.
Okay. And what happened?
Well, they all responded exactly how you would expect. They denied any wrongdoing. Believe it or not, they asserted as a defense the statute of limitations, which says we may have done something wrong, but because she took so long to sue us, she can no longer sue us.
And that is BS. That is BS.
Believe me, as an attorney, I can tell you how much that just frustrated me. But they basically circled the wagons and attempted to protect one another. But once their preliminary objections and their claim of a statute of limitations argument were ruled against by a state judge, guess what? They began filing cross complaints against each other and pointing fingers at one another.
Well, boy, I'm sorry. This is just BS. It's a train. Right. What did you do? Did you go to mediation?
So once the insurance companies realized that their initial defenses were not going to rule the day, they actually reached out to us to do a mediation. Mm-hmm.
Okay. What happened there?
Well, as a matter of fact, it did result in a settlement of our client's claims. Essentially, all the parties contributed various amounts of money, and we basically recouped all of her premiums. Wow. Not a bad result, given the fact that she initially didn't even realize that she'd been mistreated and that several of the policies were sold to her over 10 years ago.
You don't want to have a client. I wouldn't want to have to go through this. You don't want your clients to go through this.
No.
What should we as listeners take away from this?
Okay. So Patrice, life insurance can be a real lifesaver. No pun intended. When it's used for the right purposes and when designed with the best interest of the client in mind. But life insurance policies today are very complex contracts. And I can assure you that I can demonstrate to you that I can design 3 different life insurance policies with the same insurance company using the identical death benefits and annual premiums, but the results of those 3 policies will be dramatically different years down the road. The average consumer doesn't realize that permanent life insurance policies have a really wide variety of design parameters that an agent can manipulate. And those parameters can be manipulated to benefit the client, or they can be manipulated to benefit the agent. Right?
Yeah.
And so perhaps even more importantly, our listeners should be extremely wary if their financial advisor or insurance agent makes any of these recommendations. There's 4 that I really look out for. Number 1, don't worry about the premiums. We'll generate enough cash from your investments each year to pay the necessary premiums. That red flag should be waving, right? You should buy a life insurance policy, even though the annual premiums seem excessive. Don't worry. We'll find a way to pay them. Again, ding, 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 right? That bell's going off, the flag's waving. If they recommend that you replace an existing life insurance policy, particularly if you've had it for a few years, with a new, much better policy, usually, by the way, with a different company, boy, you should be backing away very quickly. And finally, if they recommend that you can use the cash in your IRA or 401k to purchase a life insurance policy, run for the hills. You have to understand that those 4 scenarios should immediately raise a red flag and should encourage a client to get a second independent opinion regarding the strategy. They may be legitimate. There may be legitimate reasons for recommending any of these solutions, but a consumer really needs to review any such recommendations with a second independent trusted advisor, attorney, or CPA, right? Our listeners need to understand that when their financial advisor is acting in the capacity of an insurance agent, that agent is not a fiduciary to the client. That financial advisor has switched hats. And that agent, when you're an agent for a life insurance company, you're actually an agent of the issuing insurance company. And my recent experience obviously confirms you simply can't rely on the internal underwriting department of the insurance company to protect you.
And that is amazingly a shame.
It is. And, I will tell you that some very large law firms that do nothing but kind of class action lawsuits are looking into this to see if insurance companies intentionally sold or allowed their agents to sell life insurance, right, to clients that couldn't afford it, knowing that premiums would be paid for a period of years.
Really?
And the policy would lapse and they would never have to pay a death benefit, right? So this is being investigated today by a very large law firm that does nothing but these class action suits. So I think there's one other important comment and a special offer we have to give to our listeners. If any of our listeners own what they believe is a permanent life insurance policy, and that policy is more than 5 years old, they absolutely must have that policy analyzed to make certain it's performing as it was originally designed and to determine if that original design is appropriate today.
Mm-hmm.
You absolutely can't take an insurance policy that you're relying on to pay a death benefit when you need it most and throw it in the drawer and forget about it, right? Even continuing to pay your scheduled premiums does not guarantee you that the policy will be enforced when you need it. Our listeners absolutely must commit to having any permanent life insurance policies reviewed on a regular basis. And I'm not suggesting that they have that policy replaced or that they surrender that policy, because there are things that you can do with existing policies that don't cause the sale of another policy, that doesn't cause an advisor to earn more commissions, but can right that ship before it's really kind of half sunk. So they absolutely have got to make certain that these policies are reviewed on a regular basis.
And no, go ahead. I'm sorry.
No, that's okay. If any of our listeners have a life insurance policy they want to analyze, we have a special offer. We're happy to review an existing policy at no charge and with absolutely no commitment to work with us. We'll provide them with a thorough written analysis that includes in-force illustrations to see if the policy's performing as originally illustrated and whether or not they should make any adjustments. And if necessary, we'll make appropriate suggestions on how to make certain that policy is in good condition. You have no idea how many policies I reviewed over the years where policies were going to lapse and be of no use well before the owner's life expectancy. There's nothing worse than paying premiums for years, even decades, only to find that the life insurance coverage you purchased won't be there when you need it.
So, John, how can listeners take advantage of this really generous offer?
So, like always, Patrice, all they need to do is reach out to us through our website, wecanhelpyou.com, and request a free, no obligation review of their life insurance policy. In addition to that, we'll even give them a stress test of their current investments to make sure that their investments are on track, that it matches their own risk scores, and that everything is functioning as it should be. A second opinion is never a bad idea. No obligation to change, no requirement that they work with us. It's a service that we give to folks out in the community.
All right. So that is wecanhelpyou.com.
Yes, ma'am.
This was a disturbing episode. Everyone,
you can imagine, Patrice, my client, when we finished the mediation, turned to me, and I honestly, Patrice, I wasn't satisfied. I wanted to get more out of these insurance companies, more compensation to this woman out of these insurance companies. But she turned to me and said, that's not a bad result. In fact, it's a good result. I didn't even realize I lost all these premium dollars. You got them all back. You got them back from me, and I didn't even realize they were gone. So it's a very, very frustrating situation. I've seen it happen time and time again in the insurance business. There are lots of insurance agents out there that are wonderful people that design policies in the best interest of their clients, but those few bad apples really make the insurance industry look bad. So get that policy reviewed.
All right. Again, that's wecanhelpyou.com. And
Yes,
listen,
ma'am.
make sure to follow this podcast to know when the next show is ready for you. And one of John's rants, I love them. Please like and share with others as well. And thanks for being with us.
Thanks, Patrice.